Topic: the effects of inflation and deflation on inventories, costs of sales, and gross margin. During a period of rising inventory costs, the cost of sales reported by a company is most likely to approximate the current cost of replacing the inventory if the company uses A. the FIFO method, B. the LIFO method, C. the weighted average cost method. Correct answer, B. Under LIFO, the most recently purchased inventory is recognized first in cost of sales. These newest purchases reflect current market prices. Cost of sales under LIFO closely approximates current replacement cost, as it uses the latest, highest purchase prices. Example: if purchases are 10, 12, and 15, LIFO assigns 15 to cost of sales, matching recent market prices. During periods of rising inventory prices, LIFO provides the most current cost of sales because it uses the latest purchase prices. FIFO and weighted average methods lag behind current market prices, as they use older or averaged costs. A. Incorrect. FIFO inventory costing method understates current replacement cost by using older, lower purchase prices for cost of sales. C. Incorrect. Weighted average method calculates average inventory cost, partially reflecting current replacement cost in rising prices. LIFO aligns current revenue with current costs, providing a more accurate picture of profitability in inflationary environments. FIFO results in higher reported profits during rising prices, but leaves ending inventory valued at current market prices. Weighted average cost provides a middle ground, but lacks the precision of LIFO in matching current costs. During a period of rising prices, the ending inventory balance of a company that uses the LIFO method, compared to the current replacement cost of that inventory, is most likely A. Understated, B. Overstated, C. Accurately stated. Correct answer, A. Under the last in, first out, LIFO method, the most recent purchases are assumed to be sold first. This means the ending inventory on the balance sheet consists of the oldest items still on hand. When prices are rising, those oldest items were purchased at lower costs than the current market prices. The current replacement cost reflects the most recent, higher prices in the market. Therefore, the LIFO ending inventory is valued at outdated, lower costs and is understated compared with current replacement cost. LIFO provides a realistic measure of cost of sales during inflation, but leaves the balance sheet inventory below its true economic value. LIFO, cost of sales approximates current cost, ending inventory is understated. FIFO, cost of sales understates current cost, ending inventory approximates current replacement cost. B. Incorrect. LIFO inventory is overstated in deflationary environments and understated in inflationary environments. C. Incorrect. LIFO inventory is inaccurate in inflationary periods as it uses historical cost layers, unlike FIFO, which reflects current replacement cost. A retail company operates in an industry experiencing deflation. To report the highest possible gross profit in this environment, the company should account for its inventory using the A. FIFO method, B. LIFO method, C. Specific identification method. Correct answer, B. In a deflationary environment, prices falling, newer inventory is purchased at lower costs than older inventory. Under LIFO, the most recent purchases, lowest cost items, are assumed to be sold first. This means cost of sales is composed of the lowest unit costs, while revenues remain based on older, higher selling prices. The result is a lower cost of sales, leading to a higher gross profit and higher net income compared to FIFO. LIFO produces the highest gross profit when prices fall, deflation. Conversely, it produces the lowest gross profit when prices rise, inflation. During rising prices, inflation, FIFO yields highest gross profit. During falling prices, deflation, LIFO yields highest gross profit. Specific identification depends on item mix, not price level trends. A. Incorrect. FIFO assumes oldest inventory is sold first, resulting in higher cost of sales and lower gross profit compared to LIFO. C. Incorrect. This method traces actual costs of individual items sold, making gross profit dependent on specific items sold. It does not consistently produce the highest gross profit under deflationary conditions. All else equal, during a period of rising inventory costs, a company using the FIFO method will report a current ratio that is most likely A. Lower than that of a company using the LIFO method. B. Higher than that of a company using the weighted average cost method. C. The same as that of a company using the specific identification method. Correct answer, B. FIFO assigns the oldest, lower cost to cost of goods sold and the newest, higher cost to ending inventory. This results in a higher ending inventory value on the balance sheet. Since inventory is a major component of current assets, a higher inventory value increases current assets. With current liabilities remaining unchanged, the current ratio, current assets divided by current liabilities, will be higher under FIFO compared to the weighted average cost method. The weighted average cost method calculates an average cost for inventory, which will be lower than the most recent costs reported under FIFO during rising prices, leading to a lower ending inventory value and a lower current ratio. FIFO results in the highest inventory value, and therefore the highest current ratio during rising prices, while LIFO results in the lowest. The weighted average cost method falls in between, and specific identification's impact is variable. A. Incorrect. LIFO results in a lower ending inventory value and current ratio compared to FIFO during rising prices. C. Incorrect. Specific identification method tracks actual item costs, impacting inventory value and current ratios differently than FIFO during rising prices. In an inflationary environment, a company using the LIFO method, compared to an otherwise identical company using the FIFO method, will most likely report A. A higher current ratio, B. A lower inventory turnover ratio, C. A lower gross profit margin. Correct answer, C. In an inflationary environment, prices are rising, so newer inventory costs more than older inventory. LIFO, last in, first out, assumes the most recently purchased higher cost inventory is sold first, leading to higher cost of goods sold COGS. FIFO, first in, first out, assumes the oldest, lower cost inventory is sold first, leading to lower COGS. Gross profit margin equals sales minus COGS divided by sales. Since LIFO results in higher COGS, gross profit is lower, and thus the gross profit margin is lower compared to FIFO. This is the most direct and significant impact of LIFO in an inflationary environment. A. Incorrect. LIFO results in a lower current ratio than FIFO due to lower inventory valuation. B. Incorrect. LIFO results in a higher inventory turnover ratio than FIFO in an inflationary environment due to higher COGS and lower average inventory. LIFO and inflation leads to higher COGS, lower gross profit, and lower gross profit margin. LIFO results in lower ending inventory, which reduces current assets and the current ratio. LIFO's higher COGS and lower inventory led to a higher inventory turnover ratio, indicating greater efficiency, though this may not always reflect operational reality. Two otherwise identical companies operate in an inflationary environment and have increasing inventory levels. Company uses LIFO and company B uses FIFO. Compared to Company B, Company A will most likely report A higher cost of sales and a lower gross profit. B, lower cost of sales and a higher gross profit. C, higher cost of sales and a higher gross profit. Correct answer, A. In an inflationary environment, prices are rising, so newer inventory is more expensive than older inventory. LIFO, Company A, the most recent higher cost inventory is sold first, leading to a higher cost of sales, COGS. FIFO, Company B, the oldest lower cost inventory is sold first, leading to a lower COGS. Since gross profit equals sales minus COGS, and sales are identical for both companies, a higher COGS for Company A results in a lower gross profit compared to Company B. Therefore, Company A LIFO will report a higher cost of sales and a lower gross profit than Company B FIFO. B, incorrect. FIFO effects differ from LIFO. LIFO is used by Company A. C, incorrect. Higher COGS reduces gross profit, making it impossible to have both simultaneously. In an inflationary environment, LIFO leads to higher COGS and lower gross profit because the most recent higher cost inventory is sold first. FIFO leads to lower COGS and higher gross profit because the oldest lower cost inventory is sold first. During a period of rising inventory costs, a company that uses the LIFO method, compared to one that uses the FIFO method, will most likely report A, lower taxes payable. B, higher gross profit. C, higher net income. Correct answer, A. In a period of rising inventory costs, inflation, LIFO, last in, first out, assigns the most recent higher cost inventory to cost of sales. COGS, leading to a higher COGS compared to FIFO, first in, first out, which assigns older, lower cost inventory to COGS. Since gross profit equals sales minus COGS, a higher COGS under LIFO results in a lower gross profit. Net income equals gross profit minus operating expenses minus taxes. A lower gross profit leads to lower taxable income, which in turn results in lower taxes payable. Therefore, a company using LIFO will most likely report lower taxes payable compared to a company using FIFO during a period of rising inventory costs. B, incorrect. LIFO results in higher COGS and lower gross profit during inflation, contrary to the statement. C, incorrect. LIFO results in lower net income than FIFO during inflation due to higher COGS and lower gross profit, despite tax savings. In a period of rising inventory costs, LIFO leads to higher COGS, lower gross profit, and lower taxes payable, but also lower net income. FIFO leads to lower COGS, higher gross profit, higher taxes payable, and higher net income. During a period of rising prices, which inventory method will result in an ending inventory balance that is most representative of the cost a company would incur to replace that inventory today? A, LIFO. B, FIFO. C, weighted average cost. Correct answer, B. Under FIFO, the oldest inventory costs are assigned to cost of goods sold, COGS, leaving the newest and highest costs in ending inventory. During rising prices, these newest costs closely match current replacement costs. This method provides the most relevant balance sheet presentation because ending inventory reflects current market prices. Example: if a company buys items at 10, 12, and 15 over time and prices rise, FIFO leaves the 15 cost items in inventory, matching today's replacement price. A, incorrect. LIFO assigns newest inventory costs to COGS, understating inventory values during rising prices. C, incorrect. Average cost method calculates inventory value by averaging all purchased items, falling between FIFO and LIFO values. It smooths price fluctuations, but is less representative of current replacement cost than FIFO during inflation. FIFO recognizes older costs first, leaving newer costs in inventory, while LIFO does the opposite. FIFO prioritizes current balance sheet relevance, while LIFO prioritizes current income statement relevance. FIFO is most sensitive to current price changes, making it the best indicator of replacement costs during inflation. Note that LIFO is prohibited under International Financial Reporting Standards, IFRS, though permitted under U.S. Generally Accepted Accounting Principles, GAAP. Companies using FIFO during inflation will report higher ending inventory values and lower COGS compared to LIFO, resulting in higher profits and taxes. From Scenario, Global Vintners Incorporated. What is the most likely justification for Global Vintners' use of the FIFO method for its purchased champagnes? A. It is the only method permitted under IFRS for purchased finished goods. B. It results in a cost of sales that closely matches the current cost of replenishing sold inventory. C. The carrying amount of ending inventory reflects the cost of the most recently purchased items. Correct answer, C. The carrying amount of ending inventory reflects the cost of the most recently purchased items. Under the FIFO method, the first items purchased are assumed to be the first ones sold. This means that the ending inventory is made up of the most recently purchased items. This results in the carrying amount of ending inventory being closer to the current replacement cost of those items, especially in periods of rising prices. It provides a more up-to-date and relevant valuation of the inventory on the balance sheet. A. Incorrect. IFRS permits multiple inventory costing methods, including FIFO and weighted average cost, provided certain criteria are met. B. Incorrect. LIFO method assumes last purchased items are sold first, matching current replenishment costs. FIFO uses older, lower-cost inventory for cost of sales calculations, resulting in a mismatch with current replenishment costs in a rising price environment. From Scenario, Global Vintners Incorporated. If the cost of grapes continues to rise and Global Vintners maintains stable inventory levels, the use of the FIFO method for its raw materials will most likely lead to A cost of sales that reflects older, lower costs. B. An ending inventory value that reflects older, lower costs. C. A cost of sales that is very similar to what would be reported under the LIFO method. Correct answer, A. Under FIFO, first in, first out, the oldest inventory items, purchased at lower prices during inflation, are assumed to be sold first. This means the cost of sales directly reflects these earlier, cheaper purchase prices. Example, if grapes cost 5 per unit first, then rise to 7 per unit, FIFO sells the 5 cost grapes first. Lower reported cost of sales compared to current replacement costs. Higher gross profit and net income during inflationary periods. B. Incorrect. FIFO ending inventory values remaining items at the most recent purchase price, making it more relevant than cost of sales. C. Incorrect. FIFO and LIFO inventory methods yield opposite results during inflation, with LIFO resulting in higher costs and lower profits. An analyst gathers the following data for Steel Dynamics Incorporated. LIFO for 2023. Reported cost of goods sold $850 million. Charges included in COGS for inventory write-downs $10 million. LIFO reserve, December 31st, 2023, $45 million. LIFO reserve, December 31st, 2022, $50 million. Reported inventory, LIFO, December 31st, 2023, $150 million. Reported inventory, LIFO, December 31st, 2022, $140 million. After adjusting to FIFO and excluding write-downs, the 2023 inventory turnover ratio is closest to 4.39, B 5.50, C 5.75. FIFO inventory is calculated by adding the LIFO inventory and LIFO reserve. The change in LIFO reserve is used to adjust COGS to a FIFO basis. Adjusted FIFO COGS is $845 million after excluding write-downs. Inventory turnover is 4.39 times. All else equal, the gross profit margin for Forge Corp, FIFO, would be higher than that of Steel Dynamics, LIFO, under which of the following price scenarios? A deflationary, B stable, C inflationary. Correct answer, C. Under inflation, prices are rising over time. FIFO, Forge Corp, uses older, lower-cost inventory for COGS. LIFO, Steel Dynamics, uses newer, higher-cost inventory for COGS. Result, FIFO's COGS is lower, so its gross profit margin is higher. Example, revenue 100. FIFO COGS, old inventory, 40, gross profit equals 60, margin equals 60%. LIFO COGS, new inventory, 60, gross profit equals 40, margin equals 40%. A. Incorrect. FIFO results in higher COGS and lower gross profit margins compared to LIFO during deflation. B. Incorrect. Stable prices result in identical FIFO and LIFO inventory costs, yielding the same COGS and gross profit margins for both companies. FIFO yields higher gross profit margins during inflation, while LIFO is better during deflation. In a period of declining inventory unit costs and stable inventory quantities, which inventory method is most likely to result in the highest return on assets? ROA, A. LIFO, B. FIFO, C. Weighted average cost. Correct answer, A. When prices are falling, the most recent purchases are cheaper than older inventory. LIFO charges these newest, lowest cost units to cost of goods sold COGS. Lower COGS increases gross profit and net income, directly raising the numerator in the ROA calculation. LIFO keeps older, higher cost inventory on the balance sheet, raising total assets slightly. The income increase generally outweighs the rise in asset value, producing a higher ROA, net income divided by average total assets. B. Incorrect. Deflation under FIFO results in higher COGS, lower gross profit, and lower net income, reducing ROA. C. Incorrect. The method averages inventory costs, resulting in COGS and ending inventory between LIFO and FIFO, and a ROA between the two. LIFO maximizes profitability in deflationary environments by matching lower costs with sales, despite slightly inflated asset values. Management noted an increase in component costs. Based on Omni technicians' disclosed inventory methods, which inventory classification would least accurately reflect these current prices? A. Raw materials, valued using weighted average cost. B. Finished goods at the U.S. subsidiary, valued using LIFO. C. Work in process, valued using weighted average cost. Correct answer, B. LIFO, last in, first out, assumes the most recently purchased items with higher current costs are sold first, leaving older, lower-cost inventory on the balance sheet. During periods of rising component costs, as noted by Omni Technicians Management, LIFO inventory balances reflect outdated, lower prices, making them the least accurate representation of current replacement costs. The LIFO reserve increased from $15 million 2022 to $25 million 2023, indicating that LIFO inventory values are significantly understated compared to FIFO or weighted average cost methods. This widening gap confirms that LIFO balances lag behind current prices. A. Incorrect. Weighted average cost method calculates an average of all inventory costs, including recent purchases, making it more reflective of current prices than LIFO. B incorrect. Weighted average cost method, used for work in process, blends old and new costs, providing a moderately current valuation during inflation. LIFO's design prioritizes matching current costs with current revenues via COGS, but at the expense of reporting outdated costs and ending inventory. Weighted average cost, while not perfect, offers a better approximation of current prices during volatile periods because it includes recent cost trends. The LIFO reserve data is critical evidence. Its increase during rising costs proves that LIFO inventory values are further removed from current replacement costs than other methods. The LIFO inventory for the U.S. subsidiary decreased, yet the LIFO reserve increased. This most likely indicates that during the period, A. Inventory costs were falling. B. A LIFO liquidation occurred. C. Inventory costs were rising. Correct answer, C. The LIFO reserve is the difference between FIFO inventory value and LIFO inventory value. When the LIFO reserve increases, it means the gap between the current cost of inventory, represented by FIFO, and the reported cost under LIFO is getting larger. This can only happen when the cost of inventory items is going up. In the given scenario, the LIFO inventory decreased, but the LIFO reserve increased. This indicates that the rise in per unit cost was so significant that it more than offset the decrease in the quantity or dollar value of inventory under LIFO. The company was adding new, more expensive inventory layers, which increased the reserve even as the overall LIFO value decreased slightly. A. Incorrect. FIFO method allocates higher cost of sales and lower ending inventory in deflationary environments compared to LIFO. B. Incorrect. LIFO liquidation unlikely due to increased LIFO reserve and management's explanation for inventory decrease. During a period of rising inventory costs, a company using FIFO rather than LIFO will report a higher A. Inventory turnover ratio. B. Current ratio. C. Debt to equity ratio. Correct answer, B. Under FIFO, ending inventory reflects the newest, highest costs, increasing current assets. The current ratio formula is current assets divided by current liabilities. With higher current assets due to higher FIFO inventory and unchanged liabilities, the ratio increases. Example, if current assets are 200 under FIFO and 180 under LIFO, same liabilities, the current ratio is higher with FIFO. Some may think FIFO's higher inventory automatically means higher turnover, but turnover depends on both COGS and inventory levels. Others might assume inventory valuation methods affect debt, but debt is typically fixed and unrelated to inventory accounting choices. A. Incorrect. FIFO results in a lower inventory turnover ratio than LIFO during rising costs due to lower COGS and higher average inventory. C. Incorrect. Debt to equity ratio decreases under FIFO during rising costs due to higher equity from lower COGS and higher net income. Compared to a company using FIFO during a period of rising unit costs, a company using LIFO will most likely appear to have better A. Liquidity. B. Efficiency. C. Profitability. Correct answer, B. Efficiency ratios measure how well a company manages its assets. Inventory turnover ratio equals cost of goods sold, COGS, divided by average inventory. Under LIFO during rising costs. COGS, numerator is higher because the newest, most expensive inventory is expensed first. Average inventory, denominator, is lower because the remaining inventory is valued at older, cheaper costs. A higher numerator and lower denominator result in a higher inventory turnover ratio. A higher turnover ratio signals that inventory is moving faster, which is interpreted as better efficiency. Example: LIFO COGS equals 200, average inventory equals 100, turnover equals 2.0. FIFO COGS equals 180, average inventory equals 120, turnover equals 1.5. LIFO shows better efficiency, higher turnover. Omni Technician's U.S. subsidiary uses LIFO, and the LIFO reserve increased from 15 million to 25 million. This indicates that cumulative LIFO effects are growing due to rising costs. The increase in the LIFO reserve confirms that COGS is higher and inventory is lower under LIFO compared to FIFO, directly supporting the impact on efficiency ratios, higher turnover. LIFO during rising costs. Higher COGS, lower profits, weaker profitability. Lower inventory, lower current assets, weaker liquidity. Higher COGS and lower inventory, higher inventory turnover, better efficiency. Therefore, LIFO makes a company appear more efficient but less liquid and less profitable compared to FIFO. Topic: presentation and disclosure. An inventory-related disclosure that is required under IFRS, but is not relevant under US GAAP is though. A carrying amount of inventories pledged as security for liabilities. The accounting policies adopted in measuring inventories. See circumstances that led to the reversal of a write-down. Correct answer, C. IFRS allows reversals of prior inventory write-downs if the reasons for the write-down, for example, decline in market value, no longer exist. Disclosure of reversal circumstances is mandatory to explain sudden increases in profit or inventory value, ensuring transparency. US GAAP prohibits reversals of inventory write-downs. Once written down, the new cost basis is irreversible, even if market conditions improve. Since reversals cannot occur, disclosing reversal circumstances is meaningless under US GAAP. IFRS adopts a dynamic approach, reflecting recoveries in market value. US GAAP follows a conservative approach, preventing earnings manipulation through reversals. A. Incorrect. Both IFRS and US GAAP require disclosure of pledged collateral assets. B. Incorrect. IFRS and US GAAP require disclosure of inventory measurement policies, crucial for understanding inventory cost estimation and reporting. Scenario: Global Vintners Incorporated. An analyst gathers the following data for Global Vintners in millions of euros. 2018 cost of sales 158 euros. 2018 ending inventory 29 euros. 2017 ending inventory 25 euros. The 2018 inventory turnover ratio is closest to A. 5.86, B. 5.45, C. 5.09. Inventory turnover calculation. Inventory turnover equals cost of sales average inventory. Average inventory calculation. Average inventory equals beginning inventory plus ending inventory 2. Inventory turnover result, 5.86. Maria Lopez is comparing Global Vintners, IFRS, to a potential US competitor. She insists on using a competitor that also reports under IFRS. Her reasoning is most likely motivated by the fact that under US GAAP, the LIFO method is permitted for inventory valuation. BL inventory must be valued at the lower of cost or net realizable value. C. The specific identification method is prohibited for homogeneous goods. Correct answer, A. US GAAP allows companies to use LIFO, last in, first out, for inventory valuation, while IFRS explicitly prohibits it. This creates major differences in financial reporting during inflationary periods. LIFO typically results in higher cost of sales and lower ending inventory values compared to FIFO, which is permitted under both frameworks. Maria wants to avoid comparing companies using different inventory methods, because this would distort profitability and inventory balance comparisons. Example: a U.S. company using LIFO during rising prices would show lower profits than an IFRS company using FIFO, even if their actual business performance is similar. Be incorrect. IFRS and US GAAP require inventory to be measured at the lower of cost or net realizable value for FIFO weighted average methods. The only difference is the lower of cost or market rule for LIFO inventory, which doesn't apply to IFRS reporters. See incorrect. Both IFRS and US GAAP allow specific identification for unique or high-value items, but discourage it for large volumes of interchangeable items due to practicality concerns. The most critical difference affecting comparability is LIFO usage under US GAAP versus its prohibition under IFRS RN. Cost of sales higher under LIFO during inflation. Ending inventory values lower under LIFO. Profitability metrics lower net income under LIFO. If Omnitech had reported under IFRS, which prohibits LIFO, its inventory turnover ratio for 2023 would most likely be A higher, B lower, C the same. Correct answer, B. Switching from LIFO to FIFO under IFRS in an inflationary environment, rising component costs decreases the inventory turnover ratio because FIFO reduces COGS, uses older, lower costs. FIFO increases average inventory, values inventory at newer, higher costs. Net result is lower ratio, smaller numerator divided by larger denominator. Omni-Technician's specific data shows FIFO inventory, 90 million, is higher than LIFO inventory, 65 million. Calculated FIFO turnover, 4.54, is lower than LIFO turnover, 5.79. Industry principle: LIFO produces higher turnover ratios than FIFO during inflation. A. Incorrect. LIFO leads to higher COGS and lower inventory, contradicting IFRS accounting treatment. C. Incorrect. LIFO and FIFO produce different inventory values and COGS in inflationary periods, preventing identical ratios. Prohibition of LIFO on IFRS forces companies to use methods that value inventory at current costs higher in inflation, match older costs to COGS lower in inflation. A review of Omni-Technician's inventory note shows a significant decrease in finished goods and raw materials, while work in process remains stable. This most likely suggests the company is struggling to sell its finished products. B. The company is anticipating a contraction in future sales. C. There have been significant price increases for raw materials. Correct answer, B. The simultaneous decrease in finished goods and raw materials, while work in process remains stable, indicates a coordinated effort to reduce inventory levels. This pattern suggests that the company is selling off its finished goods faster than it is producing them, and is also reducing its raw material purchases. Such behavior is typical when a company anticipates lower future demand and wants to avoid overstocking, which could lead to obsolete inventory or increased holding costs. Management reduced lower margin product lines, anticipating a sales contraction and focusing on higher margin products. Consumer electronics companies face rapid technological obsolescence and price competition, necessitating proactive inventory management to avoid excess stock. A. Incorrect. Decreased finished goods inventory suggests strong sales, not struggling to sell. Reducing lower margin products is a strategic move, not a sign of struggle. C. Incorrect. Decrease in inventory levels is due to strategic reduction of product lines and anticipated lower future sales, not raw material price increases. Decrease in raw materials inventory quantity and value suggest anticipation of lower future sales and reduced production and purchasing plans.